U.S.-China trade tensions are flaring up again. President Trump is threatening to block Chinese cooking oil imports after Beijing halted purchases of American soybeans. Last week, President Trump announced an additional 100% tariff on Chinese goods and new export controls on critical software, all in retaliation for Beijing's restrictions and export controls on rare earth exports, the rare earth minerals. China warning that it will respond should those tariffs take effect November 1st. Joining me now is Federal Reserve Governor Stephen Miran. Stephen, it's great to have you this morning. Welcome.
Good morning. Thanks for having me back.
Well, you've mentioned that trade uncertainty is adding, quote, new tail risks to the economy, making it more urgent for the Fed to act on rate cuts. What are the risks you see? Are you suggesting we could see a recession as a result of this?
Good morning. Yeah, I don't see a recession as a result of this. However, if the threats materialize, and to be clear, they may not, and there's a lot of time between now and December, and so this all could go away as the negotiators get to work. But if they materialize, it's a downside risk to the economy, and with monetary policy as restrictive as it is, and recall, my view is that monetary policy has recently grown a lot more restrictive than people think it has due to other changes in economic policy, like reduced migration flows and reduced deficits. But if monetary policy stays as restrictive as it is, and you have a shock like this hit the economy, it does materially increase the negative consequences of that shock. And so my perspective is that what we've done is add some more tail risk to the economy. We've added more uncertainty to the economy because China has stepped away from the deals that it had previously made. And those risks make it even more incumbent upon monetary policymakers to start removing the restriction on the economy from excessively high interest rates.
And the risks you say are around economic growth?
Yeah, these rare earth materials and magnets, they're key inputs into a number of products that the manufacturing sector makes. And if you just can't make the products because you don't have the materials, it could be very disruptive to the economy.
Well, there's also sort of, living in a vacuum, right? What's your take on jobs right now? We don't have any government data because of the government shutdown. Investors are anticipating that the Fed will cut rates again at this month's meeting. The meeting, of course, beginning October 28th. Even Fed Chair Jay Powell signaled that the Fed is on track for another move. Are you expecting it's 25 basis points? Should it be 50?
Yeah, well, my view is that it should be 50. However, I expect it to be an additional 25. And I think that we're probably set up for 3 25 basis point cuts this year for a total of 75 basis points this year. But I think that, look, it would be really helpful to have the economic data in order to be able to make the decisions we need to make. Certainly, we would want to be inspecting the economy for signs of moves lower in inflation, for signs of changes in the job market. But without those data, we still have to make a decision anyway, and so we'll have to rely upon our forecasts for doing so.
And what did you take away from the Beige Book report yesterday?
So my view is that the economy is on that economic growth has been okay for most of the year. The first half of the year was a little bit weaker than I would have liked it to have been, but my view had been that as the trade deals and the tax bill had become law, that economic growth would improve. As I said before, the uncertainty that had previously dissipated is now back because of China's changing, China's trying to change the terms of what was already agreed.
Yeah, I mean, look, we've got a lot of moving parts here, but we don't really have a good read in terms of where we are because we don't have the data. What can you tell us about your expectations going into year end without the data that we normally look at, from jobs to inflation data?
Sure. So some of my strongest expectations are actually around inflation coming down, driven in part by declines in what we call shelter inflation or housing inflation. And, one thing that I've drawn attention to is the fact that migration flows can really affect the price of housing, because the number of houses is relatively fixed in the short term. And if you were to airdrop millions of people into an economy or airdrop millions of people out of an economy, airlift millions of people out of an economy, the number of houses wouldn't adjust instantaneously. The number of houses is relatively fixed. And so when you have very, very, very substantial migration flows as we've had in recent years, it's of course going to push up the price of housing. Population growth is something that normally moves very, very slowly, but we had the biggest shocks in our lifetime in both directions. Biggest immigration shock and now biggest reduction in population growth in our lifetimes in the last few years in both directions. We had about 30 years worth of change in 3 years in both directions. So my view is that the change in border policy and the closed borders and the reduction in population growth that comes with that is actually extremely disinflationary, because it removed one of the strongest drivers of shelter inflation in recent years, one of the strongest drivers of increases in rents in recent years, and by the reduction in population growth allows the housing market to sort of of start re-equilibrating. And so my view is that inflation is actually going to be coming down quite substantially, driven through the housing channel in coming quarters.
Well, that would be welcome news, certainly. I mean, you've already seen inflation come way down as a result of President Trump's policies on energy. Look at where oil prices are right now. But the Beige Book yesterday discussed tariffs. And what do you think the takeaway was in terms of tariffs from the Beige Book?
Yeah, so obviously there are a lot of people who ascribe inflationary moves to tariffs. You know, I'm not among them. You know, my perspective is that tariffs always had the possibility of raising inflation. It may yet happen, but I don't see it in the data thus far. And the reason I don't see it in the data thus far is because I make two comparisons. One comparison that I make is whether domestically produced core goods are inflating at a different rate than imported core goods. And you don't see that. If you thought that tariffs are driving inflation, you'd expect imported core goods to be inflating materially faster than domestically produced core goods. And that's just not what we see. The other comparison I make is to compare U.S. core goods inflation to global core goods inflation. And when you look at other developed economies, it's not clear that U.S. core goods inflation has broken away from the pack in any sense. You know, and so I would, again, expect to see if tariffs were a material driver of inflation, I would expect it to show up in those two places, and it hasn't. So I've always maintained the possibility that it might induce some volatility in consumer prices, but I have yet to actually see that happen.
Yeah, and no one has. But I know your colleagues on the Fed keep bringing it up, so we're waiting for any impact here. You're focused and looking at immigration levels and the backdrop there. Do you also look at AI in terms of what that will mean for jobs?
Yeah, so it's something that people talk about a lot. You know, my perspective on AI is that it's absolutely been a driver of the economic data in recent quarters or recent years. It's difficult for me to know exactly how much of that activity would have occurred if AI hadn't existed. So would companies still be investing in data centers if not for AI, but they would be calling it investing in data centers for machine learning or some other service? So it's very difficult for me to sort of have a firm quantification, like a firm idea of the magnitude of what's happened. And it is quite possible, quite likely, that AI is improving the productivity of the economy. However, again, it's difficult for me to have a sense of the magnitude. And as to whether it affects the job market, you know, I think economists, you know, broadly speaking, should be a little bit humble about making grand predictions about the future of technology. Economists have embarrassed themselves at various points in time by being too aggressive on this. So I do think we're going to see interactions with the job market. However, the net effect is totally uncertain because for every job that maybe gets replaced by AI, we have yet to see how new jobs are going to be created because we haven't yet imagined the new categories that are going to be created as a result of AI.
Absolutely.
And so, for example, for example, you think about social media, right? Sure, it destroyed some jobs, but it also created new jobs in fields like social media strategists for advertisements.
And I make the point that, you know, years ago we didn't know we needed all these new coders, right? And these are high-paying jobs with you know, the technology boom that we're seeing. It's interesting because at the same time, President Trump is trying to get the supply chains back to America. So he's boosting manufacturing, and there is a manufacturing boom. So you've got to weigh that into what you were saying about immigration as well as AI.
Yeah, and so look, to the extent that increased manufacturing, increased investment in the United States boosts economic activity and boosts investment demand, you know, that absolutely would be bullish for the economic outlook. The question is, what does it do to the output gap and the neutral rate, which are what monetary policy should respond to? And I've attempted to do some of that analysis in my speech that I gave a couple weeks ago.
Now, the Fed recently said that they're close to being over with quantitative tightening. I want to get your take on what that looks like. And when you say we're close to that, what does that mean?
So Chairman Powell said yesterday that he thinks that we're close to the point where the Fed should stop quantitative tightening, which basically means allowing the bonds that the Fed holds to roll off our balance sheet. We should stop doing that and hold the level of reserves in the system relatively constant. I think that makes sense to me because you're starting to see the smallest hints of some, you know, sort of some modest tensions in short-term interest rates that begin to be indicative that you're getting to the level where you should sort of stop letting the number of reserves in the system go down. So that makes sense to me. But my overall view is that the number of reserves the system needs to hold, which means the size of the balance sheet, and when you do something like stop QT, is ultimately a function of the banking regulatory system that you have. And if you have a banking regulation system that requires banks to hold large numbers of reserves to meet their high quality liquid asset requirements, for example, then you need a big level of reserves in the system and a larger balance sheet. So my perspective is that we should sort of put the balance sheet issue on hold until we right size the banking system, the banking regulatory system. Once we've figured out the banking regulation system that we want, then we can go back and reevaluate what's the right size of the balance sheet. But I think it's sort of in a period in which the regulations are a bit in flux, I think sort of thinking about the right size of the balance sheet is an issue that comes a little bit down the road.
Stephen, are you surprised at this market reaction to all of this? I mean, not only do you have this melt up in stocks, but you've got money moving into gold as well. What do you think about that?
Yeah, so, I think that one of the more interesting reactions is what's happened actually in the bond market. And I think, sort of part of my argument is that because the neutral rate has whipped around, the rate at which monetary policy is neither restrictive nor accommodative has whipped around with things like population growth from immigration and things like deficits, that policy last year was less tight than I think a lot of people thought it was, which meant that cutting rates last year was a mistake. And by the same logic this year, I think that policy is more tight than a lot of people think it is, which means that cutting rates is actually the right thing to do. And I think if you look at the reaction in bond yields, you see a reaction that's consistent with that. After the Fed cut rates last year, interest rates proceeded to move 110 basis points up.
Right.
At this point, since we cut rates in September, yields are, I think, slightly down. Right, so there's a very different reaction in the bond market thus far this year versus last year that would tell me that my understanding of the world is right and that it's the right move to be cutting interest rates.
And what do you think the impact will be on the macro story if, in fact, we do see this play out where we've got 3 consistent rate cuts of 25 basis points each, 75 basis points just in the next couple of months? What's the impact on the macroeconomic story there?
Well, by making monetary policy less restrictive on the economy, you're really reducing downside risk to the economy. So shocks will hit much worse if you're very restrictive, and so by taking that away, you improve the resilience of the economy, you improve the growth outlook, you help attain the goals that Congress has assigned to the Fed, which are maximum employment and stable prices, and you take away risks from those.
Yeah, of course. What would be your assessment of growth? What kind of growth are you expecting for 2025?
Well, for 2025, probably around in the 2% area, 2% neighborhood. But the question is, what happens to growth next year?
Right.
And I think as you look forward going for growth next year, there's a number of tailwinds to the economy, such as phasing in of some of the investment incentives from the tax law that was passed this summer, which are very powerful investment incentives when you look at the economics literature. And then there's and the deregulatory effort, I think, as well, is underappreciated by economists in general. But then there's some headwinds as well. For instance, the recent trade and redevelopment of trade uncertainty that we discussed earlier due to China's recent moves.
So it depends on what happens with China. So in a 2026 scenario, do we stay at around those levels, or do you think we're looking at a much different scenario in 2026 in terms of economic growth?
Well, we'll have to see how the next few weeks play out with this trade uncertainty, but, it all could go away, over a few days. I mean, how these trade negotiations work. They can move very slowly or they can move very quickly. And if it goes away, then I think we've actually got a pretty good scenario for economic growth next year. But I also think it's reliant upon the Fed getting monetary policy to a more appropriate stance.
Of course. Fed Governor Stephen Miran, thanks very much for your analysis of all of this. We so appreciate it. Thank you.
Thanks for having me.
We'll be right back.